Listen carefully. What you are seeing in silver right now is not something you should celebrate too quickly. It may look like strength on the surface. It may look like opportunity. But I want you to understand something most people miss in moments like this. When a market like silver begins to accelerate this aggressively, especially in a fragile macro environment, the move is not just about upside. It is about pressure building underneath the system. I am not talking about a normal rally. I am not talking about healthy price discovery driven by balanced demand. This is different. This kind of movement forces you to ask a deeper question. Not how high it can go, but why it is moving this way right now at this stage of the cycle while everything else in the system is already stretched. Because that is where serious investors focus. They do not chase the move. They study the cause. Most people will look at this and assume a simple story. They will say silver is rising because inflation expectations are increasing, or because demand is strong, or because momentum traders are stepping in. But markets are never that simple. Prices are not just expressions of optimism. They are expressions of stress. They are signals of imbalance. They are reflections of forces that are not always visible on the surface. And right now, silver is sending a signal. You need to understand how the system actually works. Modern financial markets are not stable structures. They are built on layers of debt, leverage, and the assumption that liquidity will always be available when needed. During stable periods, that assumption feels justified. Prices rise, volatility stays low, risk feels manageable. People begin to believe they are in control. But that belief is always temporary, because the system does not break when everything looks weak. It breaks when everything still appears strong, but the underlying structure has already started to deteriorate. That is the phase we may be entering now. And this is exactly why I am paying attention to silver. Because when a small, highly volatile market starts moving with this kind of force, it often means capital is reacting to something deeper, not necessarily visible yet, not fully explained, but already in motion. This is not speculation. This is how cycles behave. Late-stage cycles are always deceptive. They reward risk-taking right up until the point where they punish it. They create the illusion that leverage is safe, that liquidity is endless, that policymakers can always step in before anything breaks, and that illusion becomes strongest just before conditions begin to change. I have seen this pattern repeat again and again. Leverage builds quietly. Risk accumulates beneath the surface. Asset prices continue rising, reinforcing confidence. And then something shifts, not always dramatically at first. Sometimes it begins with subtle distortions, unusual moves, unexpected volatility, signals that do not quite fit the narrative everyone is comfortable believing. This could be one of those signals, because leverage does not just amplify gains. It creates fragility. It creates a system where even small changes can trigger outsized reactions, and when prices begin moving too quickly, the structure that supported those gains starts to demand something in return: more collateral, more liquidity, more stability than many participants actually have. And that is where the problem begins. Because when pressure enters a leveraged system, investors do not behave rationally. They behave mechanically. They do not sell based on long-term conviction. They sell based on necessity. They sell what they can sell. They sell what is liquid. They sell what allows them to survive. And that process does not unfold slowly. It accelerates. This is why I want you to stop looking at silver as just a trade. Stop looking at it as just an inflation hedge or a short-term opportunity. Start looking at it as a signal within a much larger system. Because silver occupies a very specific position. It is small enough that flows can move it quickly. It is volatile enough that leverage can magnify those moves. It is monetary enough to attract defensive capital. And it is accessible enough to draw in speculative participation at exactly the wrong time. So when it moves like this, I pay attention. Not because every surge leads to a crisis, but because in the wrong environment, a surge like this can be an early indication that something deeper is shifting. something that has not yet fully revealed itself across broader markets. And this is where most investors make a critical mistake. They focus on the visible, the price, the breakout, the momentum. They convince themselves that strength confirms safety, that rising prices validate the story they want to believe. But strength can be misleading, because markets do not signal danger with clarity. They signal it through behavior, through instability, through moves that seem powerful, but are actually driven by underlying pressure. And if you do not understand that, you will misread the moment entirely. You will think this is an opportunity to chase, when in reality, it may be a moment to step back and evaluate your exposure, your structure, your assumptions about how stable this system really is. Because the real question is not whether silver continues higher. The real question is what this move is telling you about liquidity, about leverage, and about confidence across the entire financial system. And once you start asking that question, you begin to see things differently. You begin to understand that markets are not isolated. They are connected. Credit affects liquidity. Liquidity affects asset prices. Asset prices affect collateral. Collateral affects leverage. And leverage determines how investors behave under pressure. That chain reaction is always there. It just becomes visible at different stages of the cycle. Right now, it may be starting to surface. And if that is the case, then what you are witnessing is not just a silver rally. It is the early stage of a much larger shift, one that most people are not prepared for. Now I want you to take this one step further, because this is where the situation becomes far more serious than most people realize. You have to understand how leverage actually behaves when pressure begins to build. A leveraged system does not adjust smoothly. It does not gradually reduce risk in an orderly way. It reacts abruptly. It forces decisions. And once that process starts, it feeds on itself. This is why I said earlier, this never ends quietly. When investors use leverage, they are not controlling positions with fully paid capital. They are controlling them with borrowed exposure supported by collateral. As long as prices remain stable or continue rising, everything appears under control. Confidence builds. Risk feels justified. But that stability is conditional. The moment volatility begins to expand, the entire structure changes. What looked like a strong position suddenly becomes fragile. What felt like manageable risk becomes something that requires immediate attention. And that is when the system begins to shift from voluntary behavior to forced behavior. Because once price movement accelerates, margin requirements follow. More collateral is demanded, more liquidity is required, and if it cannot be provided quickly, positions are reduced, not by choice, but by necessity. That is the mechanism most people do not fully understand. Markets are not driven only by opinions, they are driven by constraints. And when constraints tighten, your behavior changes instantly. Selling begins, prices move lower. That movement triggers additional margin pressure. More positions are forced to unwind. And what started as a manageable adjustment can quickly become a cascade. You need to understand how fast that can happen. Because in a highly leveraged environment, it does not take a major event to trigger instability. It only takes a shift in conditions, a change in liquidity, a rise in volatility, a break in confidence. And once that threshold is crossed, the system does the rest on its own. This is why experienced investors do not just study price. They study structure. Price tells you what already happened. Structure tells you what could happen next. And right now, the structure matters more than the story. Because silver is not moving in isolation. It is moving within a broader environment where debt remains elevated, where liquidity is no longer expanding freely, and where confidence in policy is being tested. That combination changes everything. A silver surge in a loose liquidity environment carries one meaning. It suggests enthusiasm. It suggests expansion. It suggests risk appetite. But a silver surge in a tightening environment carries a completely different message. It may be signaling stress. It may be signaling defensive positioning. It may be signaling that capital is beginning to move ahead of a shift that the majority has not yet recognized. And this is where the gap between disciplined investors and the crowd becomes very clear. The crowd reacts to what is obvious: the price, the headlines, the narrative that feels comfortable. Disciplined investors focus on what is not yet obvious: the underlying pressure, the changing conditions, the signals that do not fit neatly into a simple story, because that is where the real information exists. Most people are still looking at this through a narrow lens. They are asking whether silver is breaking out, whether it can go higher, whether this is the beginning of a major bull move. But those are surface-level questions. The deeper question is whether this move is connected to a shift in liquidity and leverage that will eventually affect other markets. Because if that is the case, then this is not just about silver. This is about the stability of the system itself. And history has shown this very clearly. Major disruptions do not begin when everything looks broken. They begin when everything still appears functional, but the underlying structure is already under strain. They begin when leverage is high, when confidence is still present but weakening, when small signals start appearing in places most people are not paying attention to. Silver can be one of those places, because it sits at the intersection of multiple forces. It is influenced by monetary dynamics, by industrial demand, by investor psychology, and by liquidity flows. That makes it uniquely sensitive to shifts in the system. So when it moves aggressively in an unstable environment, it demands attention. Not excitement, not blind optimism. Attention, because this is how misinterpretation happens. People see the move and assume it confirms strength. They chase it. They increase exposure. They position themselves for continuation without understanding the underlying conditions that are driving the move. And that is exactly how the majority gets trapped. Because structural fragility does not announce itself clearly. It shows up through volatility, through dislocations, through behavior that does not align with the prevailing narrative. And by the time the narrative adjusts, it is already too late to react comfortably. This is why I want you to think in terms of scenarios, not certainties. I am not telling you that a crisis is guaranteed. That would be too simplistic. What I am telling you is that the probability of instability increases when you see signals like this in a fragile environment. And your job is not to predict the exact outcome. Your job is to prepare for the range of possible outcomes, because that is what separates resilient investors from vulnerable ones. Resilient investors do not rely on one outcome being correct. They build structures that can withstand multiple outcomes. They think about liquidity. They think about flexibility. They think about how their portfolio behaves under stress, not just under ideal conditions. And that mindset becomes critical at moments like this, because if volatility continues to expand, if liquidity continues to tighten, and if leverage begins to unwind across the system, then the environment can change very quickly, faster than most people are prepared for. And that is where mistakes become costly. Because in a stressed system, it is not enough to be right eventually. You have to survive the transition. You have to avoid being forced out at the worst possible moment. You have to maintain control while others are losing it. That is the real challenge. And that is why I keep coming back to this idea. This is not about chasing a silver rally. This is about interpreting a signal. A signal that may be telling you that conditions are shifting. A signal that may be telling you that the system is becoming less stable. A signal that may be telling you that the next phase of the cycle is approaching faster than most people expect. And if you ignore that signal, you are not just missing an opportunity. You are exposing yourself to a risk you do not fully understand. That is the difference. And that difference is what determines who preserves capital and who loses it when the cycle turns. Now, I want you to confront the part most investors avoid, because this is where the real consequences begin to take shape. Most people think of a market break as a sudden event, something dramatic, something obvious. One day everything looks fine, and the next day everything collapses. But that is not how these cycles actually unfold. They build slowly. They build through excess debt, through distorted incentives, through policies that extend stability at the cost of increasing fragility. And most importantly, they build through belief. The belief that because the system is not broken yet, it will not break at all. That belief is what traps the majority. Because debt cycles are not driven by optimism, they are driven by mathematics. They depend on whether obligations can be sustained, whether refinancing remains possible, and whether liquidity continues to support the structure. When those conditions begin to weaken, the system does not announce it clearly. It signals it through volatility, through unusual price behavior, through movements that seem disconnected from the comfortable narrative people want to believe. And this is why I keep bringing you back to silver, because silver sits in a unique position within this entire system. It is not just a commodity. It is not just a monetary metal. It reflects multiple layers of the financial structure at once. It reacts to inflation expectations. It reacts to currency confidence. It reacts to liquidity flows. It reacts to investor psychology. So when it begins to move with intensity in an environment that is already unstable, I do not ignore it. I study it. Because history shows the same pattern repeating again and again. Late-stage cycles always create the illusion of control. Investors begin to believe that downturns can be managed, that central banks can stabilize any disruption, that liquidity will always arrive when needed. And for a period of time, that belief appears correct. But what is really happening beneath the surface is very different. Leverage is expanding faster than resilience. Risk is building faster than the system can absorb. Confidence becomes dependent on continuation. And the moment continuation is interrupted, behavior changes rapidly. The same participants who were comfortable taking risk suddenly become focused on survival. They look for liquidity. They look for safety. They look for ways to reduce exposure. And that is when markets stop behaving like engines of growth and start behaving like mechanisms of liquidation. Positions are cut. Risk is repriced. Correlations change. Assets that were expected to rise begin to fall. And participants who only understood the surface narrative are left confused, reacting instead of anticipating. This is where the separation happens. Emotional investors look at price and ask what is going up. Serious investors look at conditions and ask why. Emotional investors chase momentum. Serious investors analyze structure. You emotional investors assume strength equals safety. Serious investors understand that some forms of strength are actually warnings. That shift in thinking is not optional at this stage of the cycle, because if you misinterpret a warning as an invitation, you position yourself on the wrong side of the transition. Now think carefully about what tightening liquidity actually means. It means cash becomes more valuable. It means refinancing becomes more difficult. It means weak balance sheets are exposed. It means leverage becomes dangerous, and it means that the margin for error disappears. This is not theory. This is mechanical reality. Debt that was easy to carry becomes difficult to sustain. Positions that looked stable become vulnerable. And investors who depended on favorable conditions suddenly find themselves in a situation where those conditions no longer exist. That is how fragility reveals itself, not all at once, but in stages. If silver is rising because confidence in financial assets is weakening, that tells you something important. If it is rising because inflation concerns are re-emerging, that tells you something else. If it is rising because capital is quietly repositioning ahead of instability, that may be the most important signal of all, because that is how major shifts begin. Not with agreement, but with divergence. Not when everyone understands, but when only a few are paying attention. And while the majority continues to rely on the old narrative, disciplined capital begins adjusting, quietly, strategically, without needing confirmation from headlines. This is what creates the gap between those who react and those who prepare. Because preparation requires something most people resist. It requires uncertainty. It requires accepting that you may not know the exact timing, but you understand the direction of risk. It requires building a structure that can withstand multiple outcomes, not just the one you hope will happen. And that is where most investors fail. They want certainty. They want a clear answer. They want to believe that the path ahead will be simple and predictable. But cycles are never simple. They move through phases. In one phase, risk assets decline. In another phase, policy responses change the environment. In another phase, hard assets begin to outperform, and all of these phases can exist within the same broader transition. That is why the real issue is not prediction. It is positioning. Can you navigate the transition without being forced into bad decisions? Can you remain liquid while others are trapped? Can you stay rational while volatility increases? Because this is where most losses occur. Not because investors were completely wrong, but because their structure could not withstand the pressure. They were over-leveraged, over-concentrated, overconfident in a single outcome, and when conditions changed, they had no flexibility, no room to adapt, no ability to hold through volatility. That is what destroys capital. Not just bad ideas, but fragile structures. Markets do not reward intelligence alone. They reward discipline. They reward liquidity. They reward the ability to remain stable while others are forced into instability. And that is exactly why moments like this matter, because they force you to ask the questions that determine your outcome. Are you prepared for a shift in conditions? Are you positioned for resilience? Or are you simply reacting to what feels strong right now? Because if this silver move is not just a rally, but part of a larger signal, then your response to it matters far more than the move itself. It determines whether you protect your capital or expose it, whether you remain in control or become reactive, whether you navigate the cycle or get caught inside it. This is the final part of our script. The script ends here.